Let's get more on the equity markets. We are joined by Lyle Stein, president of Forvest Global Wealth Management. Interesting, great to see you, Lyle, as ever. Investors seemingly calm this morning, certainly in terms of U.S. stocks.
Yeah, but today's a day. Yesterday was a different day. It's been an amazing quarter when you really look at it. We had that, you saw it on the charts, right? That huge V-shaped collapse and recovery, whether it's tariffs, whether it's oil. There's a perception of a lot of uncertainty out there in people's minds. And the volatility that results from that uncertainty, people don't generally like, and they tend to panic a bit. And so the question is, how do you manage wealth in a period of time when uncertainty and the risks associated with it seem so high? Traditionally, it's been, well, you have more bonds in your portfolio. A 60-40 or a 70-30 portfolio would be ideal depending on your age or some other extraneous factor. But the reality is there's a lot of this volatility that you don't even need to worry about. We like to call it your comfort bucket and your calamity buckets. If you look at your portfolio, not in terms of stocks and bonds, but rather how much you need for income, we call that the comfort amount. How do you protect that income stream with perhaps inflation risks? Well, there are vehicles such as TIPS and gold, which we've owned. There are other ways to protect calamity. Oil is another one of those calamities you want to be careful about. Lots of things you can do. And then if you're protected and you get your income streams, high quality dividends, you don't need to worry about the day-to-day market swings. That impacts sort of the third bucket that we would call your growth bucket or your children's bucket, because frankly, if you've got your income covered and you've got the calamity protected, the rest of the money is for there in the future. And that's not, for most people, the majority of their portfolio.
So I got a little lost there.
Sure,
so
sorry.
When you see a near war in the Middle East like this between Iran and Israel, where does that fit in, Lyle?
Well, that's one of those uncertainties that always looks very difficult in the moment. But the reality is we've seen wars, we've seen things in the Mideast go up and down many, many, many times in our careers. That's just part of the uncertainty. The question is, how did you design, how did you create your portfolio to protect it, not in the instant moment, but 6 months in advance or 12 months in advance or 18 or actually 5 years in advance? The whole concept of laddering a bond portfolio is exactly that. It's generating comfort income on a certainty basis. So you don't have to worry so much about the swings, as painful as they might look in the near term.
And you have a piece of wisdom for us that applies to life in general. Just don't worry about things you can't control.
Precisely. Good old Willie Randolph, second baseman, New York Yankees manager, said, I don't worry. He said, there's two things in life you can worry about. You can worry about the things you control, but then why worry about them if you can control them? Or you can worry about the things you can't control, but if you can't control them, why worry? So why worry?
When it comes back, just looping back to that 60-40, 60 stocks, 40% equity portfolio, or even a more aggressive version, 70 stocks, 30 bonds. You feel that could be outdated, or people should take it with a pinch of salt, that model?
Well, it's a simple model, and life isn't so simple. And a 70-30 model would be one that a more growth-oriented, a more aggressive-oriented investor might consider. But if you look at it just purely, okay, now I got 30% to my comfort, is that really enough? And that's the question that we have to ask ourselves. And traditionally, that 30% has been in, bond funds or things like that. And bond funds have done awful, as we've seen, since the pandemic, and really since the post-global financial crisis. The bond market hasn't been the place that it traditionally has been. But in the pandemic, we saw that it didn't provide the safety that people were really looking for.
Right. So, but people should presumably hold some bonds.
Well, it depends. I mean, if you have your income needs, what do you need a bond for? Right? I mean, if you're covered, if your job is providing all the income you need, or your pension income, or your rent from your rental property is providing your income, what do you need a bond for? In the longer run, stocks tend to do better. They always have. You just have to ignore the near term and focus on the long term.
I suppose if we got into a deflationary environment, stocks would be likely to drop. I know that's a drastic scenario, but bonds would be likely to do well.
Well, possibly. But we're in one of those periods right now. We're all talking about disinflation, yet the next step of deflation isn't pretty. Sometimes it's a depression. And what we're worried about in the markets today, look at what the U.S. 10-year has not done. It hasn't moved during this whole period of crisis, during this whole period of tariff war. People are getting nervous about the safety of the government bond. That's why the U.S. 10-year is stuck in the 440, 450 range.
Yeah, it's interesting. It did a few weeks ago went up, and then Trump backed down on some of his tariff measures.
But it's not doing what it traditionally does in times of more worry than not. And so the question that investors seriously, I think, have to address is, how safe is my fixed income? How safe is that comfort component of my portfolio? And a 30% or 40% or even 10% may not be as safe as we saw from sort of 20 to 25.
Sometimes I ask guests this, Lyle, why would you not just put your entire portfolio into blue chip Canadian dividend stocks?
Good question. It's actually an excellent question, because a component of that is income. You've got the banks and the traditional utilities, and the other side is the growth. And so you do have your comfort bucket. And actually, in a Canadian portfolio, you have that calamity protection as well, because our market's now 10% in the gold shares. So it's a nice way to start. And I think as a younger investor accumulated savings for the long term, it's a great place to be.